Good morning, everyone. Good morning, everyone.
Good morning.
It's certainly my honor and my privilege to be here, and I want to thank all of you for being here. And I want to thank Maya and Global Policy Solutions, the Carolina Population Center at the University of North Carolina, the Research Network for Racial and Ethnic Inequality at Duke, and the Milano Graduate School of International Affairs Management and Urban Policy at the New School. I also want to thank the Insight Center on Community Economic Development and the Ford Foundation for your work. And I know that without you, the landmark Beyond Broke report would not have been possible. Ladies and gentlemen, as economic disparities grow between the haves and the have-nots, we must remain focused on ensuring all Americans have the opportunity to live the American dream. We must also remember that minorities have a long road to walk just to get back to where they were when the recession began. The Beyond Broke report, released by the Center for Global Policy Solutions and its partners, reveals just how wide the gap between the net wealth of white households and minority households is, and details how extensive the financial struggles of the minority community really are. The first and simplest step we should take to address income inequality and to ensure that all Americans can begin to recover from the recession should be to raise the minimum wage. A full-time job in this nation should enable a family to live above the poverty line, and yet it does not. This is simply wrong. Of course, the focus of today's event is about housing and our housing policy. Approximately 4.9 million homes have been foreclosed since the Great Recession began. Just yesterday, we learned that home ownership has fallen to its lowest level in this nation in nearly 2 decades. However, not surprisingly, the foreclosure crisis has a disproportionate impact on communities of color. According to a report issued in May 2013 by the Alliance for a Just Society, zip codes with a majority population of people of color experienced 17 foreclosures per 1,000 households. By comparison, white communities experienced only 10 foreclosures per 1,000 households. The Beyond Broke report finds that between 2005 and 2011, median home equity declined by more than 1/3 for all Americans. However, while whites lost 32% of the equity in their homes, Hispanics lost more than half the equity in their home value. For many families, a home is the largest single investment they will ever make, and particularly in the minority communities, it is a critical source of intergenerational wealth. The Beyond Broke report confirms this fact, finding that home equity accounts for 58% of the wealth of whites, but it accounts for about more than 90% of the personal net for African Americans. Home ownership is also the first step to a better life for many, as it was for my family in Baltimore. If people cannot buy their own homes, there are many subsequent steps they may be delayed in taking or may never take in their entire lifetime. For that reason, we must ensure that hardworking families are not shut out of the credit market by standards that are more restrictive than needed to ensure the safety and soundness of the market. Ladies and gentlemen, let me also remind you that the foreclosure crisis is not over. Let me say that again. The foreclosure crisis is not over. CoreLogic reports that as of February of this year, nearly 1.9 million mortgages were seriously delinquent, meaning borrowers were 90 or more days past due on their mortgage payments, including approximately 752,000 homes that were in some state of foreclosure. This is an improvement from the darkest hours of the housing crisis, but far too many Americans continue to struggle. And again, minority communities continue to be disproportionately affected. According to Realty Track, as of March of this year, the foreclosure rate in my state of Maryland was 1 in every 527 homes. the second highest rate in the country. However, in Prince George's County, the foreclosure rate was 1 in every 203 homes, and in my hometown, Baltimore City, it was 1 of 492 homes. The Beyond Broke report found that African American homeowners are 86% more likely to be underwater than whites, while Latinos are 36% more likely to be underwater than are their white counterparts. Programs that help keep homeowners who are underwater or having difficulty meeting their mortgage payments in their homes are still vitally needed. And the expansion of these programs can increase the number of borrowers we can help. In December of last year, the Senate finally confirmed my former colleague, Congressman Noel Watt, as the Federal Housing Finance Agency's new director. In Mel, we have a director who has the deep expertise in housing policy and the proven commitment to consumer protection we need to manage our nation's housing agenda. I hope that under Mel's leadership, FHFA will finally move to allow principal reduction modifications on loans owned or backed by Fannie Mae and Freddie Mac. At my request, go ahead, you can clap for that. At my request, the Congressional Budget Office analyzed principal, now listen to this. At my request, the Congressional Budget Office analyzed principal reduction and found that it would be a win-win-win for our country, helping United States taxpayers, American homeowners, and our nation's economy. And I believe its implementation at the GSEs is long, long overdue. We must also continue to work to identify the full extent of the abusive and improper practices that were common in past years, and we must ensure that banks and non-bank servicers that are increasingly servicing mortgages have made the systemic changes needed to fully comply with sound business standards. As ranking member of the House Oversight Committee, I continue to investigate illegal foreclosures, inflated fees, and other improper mortgage servicing practices. Just last week, as part of an investigation I launched at the beginning of this Congress with Senator Elizabeth Warren, I sent a letter to the Oversight Committee Chairman, Congressman Darrell Issa, asking him to hold a hearing in our committee to examine the settlement that ended the independent foreclosure review. Some of you may be very familiar. The OCC and the Federal Reserve have argued that the decision to terminate the IFR in January 2013 before a single borrower received remediation was made because it was, quote, to get more money to more people more quickly, and it will speed recovery in the nation's housing markets, end of quote, faster than continuing the IFR process. Documents Chairman Issa and I have obtained confirm that although some independent consultants conducting the foreclosure review had not reviewed enough loan files to determine reliable error rates, in some cases, preliminary data had identified double-digit, listen to what I'm saying, double-digit error rates in the assessment of fees, processing of loan modifications, and the management of the foreclosure process, which meant people were losing their homes based on errors. The consultants had made extensive preparations for deep dive reviews to identify the full extent of harm suffered by borrowers, but the IFR was terminated before those reviews could be conducted. Earlier this week, the Government Accountability Office released an analysis of the termination of the IFR that confirmed these conclusions. The GAOs also raised troubling new questions about the foreclosure prevention activities that were announced as part of the settlement. According to the GAO, and I quote, listen to this, regulators did not establish specific objectives for the $6 billion obligation they negotiated with servicers to provide foreclosure prevention actions, and most servicers indicated, quote, they would be able to meet the required volume of activities using their existing foreclosure prevention activities, end of quote. I didn't say that. GAO said that. If the settlement didn't require services to do anything they weren't already doing, what was the real benefit to consumers? Of course, GAO also found that the regulators have not yet conducted any oversight over the foreclosure prevention activities banks are undertaking under this settlement. As such, I doubt even regulators know what the benefits to consumers were or what they have been. It is absolutely critical that we have a hearing to examine all the facts of the determination of the independent foreclosure review so that the public can have confidence in the sufficiency and integrity of the settlement. Going forward, whenever, and I hope our panelists will talk about this, whenever a new settlement is reached, it needs to provide complete transparency, and it needs to ensure that there is real accountability for the implementation of provisions that are intended to benefit consumers. I applaud Joseph Smith's work on the national mortgage settlement. I believe that an independent monitor should have been created to oversee the settlement that ended the IFR. For that reason, in April of last year, I introduced H.R. 1706, the Mortgage Settlement Monitoring Act, which would have created an Office of Independent Monitor to assess the compliance of all parties to the amended consent orders that ended the IFR. Under this bill, the independent monitor would have been tasked with providing quarterly reports to Congress and to the public detailing key information regarding both the direct assistance and the mortgage modifications provided under settlement agreements, including demographic information that would enable us to know whether the assistance reached all of our communities. While Congress did not act on the legislation, I believe that going forward, all mortgage-related settlements should be reviewed by an independent monitor, and such monitors must be empowered to collect the kinds of data that will enable us to know whether these settlements are really providing meaningful benefits to those who have suffered harm. As I close, let me address one last issue, and that is reform of the government-sponsored enterprises. Certainly, any legislation enacted by Congress must ensure that taxpayer dollars are protected from risky business practices. But any discussion of housing reform must also focus on maximizing Americans' opportunities for home ownership. Our housing policies must ensure the continued availability of the 30-year fixed-rate mortgage. Credit-worthy borrowers' access to sustainable credit must be maximized, especially first-time homebuyers, low to moderate income purchasers, and those from communities of color. We should also ensure that all financial institutions can fairly compete in the marketplace. And finally, let me be clear that affordable housing goals did not, I repeat, affordable housing goals did not cause the housing crisis. And affordable housing cannot be an afterthought as we reform the housing market. There are a number of other housing issues and initiatives on which I'm working, but being conscious of my time and the fact that we've got a vote going on, I want to close by, again, thanking Maya and each of you for your unwavering efforts to support affordable housing for all. As I said when I began this address, we have a lot of work to do. We should begin by making sure that a full-time job pays enough to enable the worker to lift his or her family out of poverty. We must continue to even expand our ongoing efforts to help distressed homeowners. We must continue to examine the termination of independent foreclosure review. This was the final chance we had to get a full accounting of mortgage servicers' improper and abusive practices, and it was terminated before producing any reliable data about error rates. We must ensure that settlements related to improper mortgage servicing practices really benefit consumers and those who have been harmed. And finally, as we consider broader reform of the housing market, we must remain focused on ensuring the market enables all Americans, including communities of color, to open the door to home ownership and to climb up the economic ladder. And with that, I thank you very much.